want to spotlight the action we're seeing play out here in Netflix shares after the company reported earnings after the bell yesterday. Right now, shares off more than 6% as investors continue to dig through and debate the updates they got for the quarter out of the streaming giant. On the top line, a lot to applaud there as revenue was stronger than expected at $6.4 billion for the quarter. But critics are really focusing on weaker than expected subscriber growth for the quarter, as well as guidance for Q4. And for more on that, I want to bring on Yahoo Finance's Dan Roberts to discuss. And Dan, I mean, pros, cons here. Where do you fall?
Well, look, Zach, first of all, I tweeted this out in the moment, but you never want to see the earnings press release start with, as expected, growth has slowed. And look, Netflix earnings, the story is always the subscriber ads. I mean, a revenue beat, earnings slightly missed, but the street just cares about subscriber ads. Soon, maybe that narrative will finally shift because we're seeing how it's a little bit dated. So as you mentioned, Netflix added 2.2 million new subscribers in the quarter. That was seen as pretty measly compared to what the street expected of 3.3 million. Now, Netflix kind of countered that by saying, look, in the first 6 months of 2020, we added more new subscribers than in all of 2019. And I think that's pretty fair, although it's also an excuse meant to kind of, detract from the miss. But I think most interesting to me, what really stood out is in that earnings release, the company acknowledged and used this very phrase of the pull forward effect. And we have heard about this kind of dreaded pull forward in demand about a number of companies that have flown high during the pandemic. Analysts said it about Peloton at first. And for now, we'll see. But for now, it looks like that was not correct because Peloton continues to see great orders. People were concerned. Analysts were concerned that it was a pull forward in demand effect and that would hurt Peloton later. Same with Restoration Hardware, which that stock has been up like 250%. A recent downgrade on RH said, well, maybe it's just a pull forward in demand because people are sprucing up their home offices. Now, with Netflix, it actually makes sense. I mean, it's tempting to think who that hasn't subscribed to Netflix yet is going to. I mean, if you haven't subscribed at this point, what are you waiting for? The answer was there were people who hadn't yet subscribed. And because amid the pandemic, Netflix had to use a lot of its dry powder, so to speak, put a lot of its originals out on the platform sooner than it would have, you did see a pull forward in subscribers. But that doesn't necessarily have to mean a freak out. I mean, I'm just not at all convinced that there should be any concern about Netflix in the next year or so. Yes, there's more competition than ever before, Disney breathing down its neck, but you can add the subscribers now or you can add them later. And Netflix also was careful to say that something like if the quarter had just lasted a few more days, we would have beat the number of expected subs. So it's all about where you draw that line. I mean, I don't mean to sound like such a bull. I think that, in some ways, Netflix does need to be concerned about the competition, but it just has such a huge head start that I'm just not convinced there's any cause for big concern.
Well, the other thing, and I'll come out and admit that, we've spotlighted this issue before for Netflix on the show and looking at free cash flow and how, for years, Netflix has been burning through cash. We're talking billions of dollars in production and other expenses here when we look at Netflix. But this quarter, credit where credit's due, and it's something that Bank of America highlighted as well in terms of the long-term story here. For the quarter, it's worth pointing out how they've improved so much on that front. I mean, when you talk about used to negative billions of dollars, now shifting in these quarters, the last 3 quarters, to positive billions. Talk to me about that and how that might change as production picks back up in Q4.
Well, exactly right. I mean, because they weren't able to film shows, they saved a lot of money. I mean, surprise, surprise. And in fact, Netflix mentioning that filming or production has finally begun again on some of those originals. The next season of The Witcher, which is a show people love. I tried to watch it. I just couldn't quite understand. But Stranger Things the next season. There's a Netflix original movie with Dwayne "The Rock" Johnson that is starting filming. So, that spending is going to go up. But yeah, there's a lot to like right now. Not only the cash flow, but maybe we have to rethink the way that we evaluate Netflix earnings because we just saw news last week of Disney's reorg, and it's all about spending more on streaming. And it's interesting. There was a note that pointed out that, look, it's not an apples to apples comparison, but technically Disney quietly spends more on content than Netflix. And you're right. For years, the big knock on Netflix was, look how much you're spending. They're burning so much cash. They're spending so much on original content. Well, if you add in, networks and sports programming and the broadcast side, I mean, Disney actually spends more and they're about to spend even more. And yet the street is applauding that. So, people clearly kind of pick and choose what they want to say they like and what they don't like. I think there's still a lot to like about Netflix, despite, having to reassess the expectations for the new subscriber ads for the next quarter and probably for the next year as a result of the bang out, first half of 2020 they had.
That's a very good point. Pros and cons. We'll let the viewers decide on where they want to go. Nonetheless, right now, Netflix shares still off by about 6%. Dan Roberts, appreciate you joining us to break that down.